Well, this is a very hot topic, and that is the topic of departure tax. Over the last few years, I know certainly in my financial planning practice, I've had a number of clients approach me on questions regarding leaving Canada, expatriating their assets, and moving to where money is being treated more fairly in their view. There are some obvious concerns with moving out of Canada, the departure tax, what things you might be giving up, and some of the things you may be gaining. Today, I'm very, very pleased to introduce Scott Cloutte from McCarney Group LLP, who's a tax advisory specialist. And Scott, maybe I'll throw this over to you for a quick bio about you and McCarney Group.
Yeah, thank you, Mike, for letting me join you on this presentation here. Scott Cloutte, I've been practicing for almost 25 years in the tax space, tax partner at McCarney Group LLP. We're based out of the GTA area. I've been with McCarney for about 12 years, and we deal mostly with owner-managed businesses. And with that does come the topic of I'm fed up for various reasons, and I'm looking to leave Canada, just make it work, and I'm like, okay, hold on. We need to know a little bit more. So we'll dive into that subject matter and hopefully educate the listeners a little bit more on the topic.
Fantastic. Well, again, I appreciate you being able to put some of the time, some of your valuable time together for us today. But Scott, would love to know one little anecdotal bit of bioinformation or background information about you. Maybe you could share something interesting for some of the watchers.
Yeah, I've had the pleasure of, living in various parts of Canada as well as overseas for a little bit of time in my earlier years. Probably have the fortunate to have a lot of perspective as it relates to West Coast, East Coast. Lived in Vancouver for and Victoria for about 10 years. Grew up in Montreal. Was there for about 10 years. And during university, spent some time in the Philippines, and even earlier before that, when my father was an expat in Saudi Arabia for a couple of years. So I've had the fortunate blessing of kind of moving around, getting perspective, understanding a little bit about how people are thinking outside of just Toronto, because I know that's where the center of the universe is, Toronto, but ultimately, it gives me good perspective. So I do appreciate understanding kind of different perspectives from where people are living. Yeah.
That's fantastic. Well, very opportune time to have this call today because just Tuesday was the pronouncement of the 2025 federal budget. Some people may feel that that's about 6 months late in the year, that it should have been pronounced earlier in the year. But nonetheless, we have Finance Minister Champagne, who is now tabled a 406-page document all about how they're going to spend into oblivion. What's the word on the street from the tax community? What was some of the pros, cons, or maybe interesting things that weren't included in the budget, Scott?
Yeah, it was interesting before the budget took place, was trying to anticipate kind of exactly what would happen. And didn't seem like there would be a lot of policy change coming through on speculation, at least from the groups I've been talking with. So they're really nothing too significant, I would say. There's a couple of things that people are happy to hear and confirm what is the case, but there was no personal or corporate tax rate changes, individual kind of policy difference. There wasn't really a lot there. There's a little bit on automatic returns maybe being kind of part of the system for some of the lower income earners. And that would work by way of CRA sending essentially kind of a summary of what they have on file, and for you to say it looks good. And it may speed up the processing of various things for lower income. So that's good, and making sure that they get their benefits. Other than that, I wouldn't say there was really a lot going on personally on the personal side of things. On the corporate side of things, I would say, we were happy to hear confirmation that there would be no capital gain inclusion rate increase, which was speculated and expected. A little bit of change on shred credits for those investing in Canada and technology. There's a little bit of a bump to the eligible amount that people can get credits on. So from 3 million to 4.5 million is the base. And for that refundable tax that people can get on shred, it will make a difference if they're spending over 3 million. So that's good. A little bit of a change, not a big change. It was more just a continuation of what was already in place with accelerated CCA, which is the tax depreciation rules, not necessarily specific to any industry. It was before where M&P assets were more favored, but in this case, it's broader scope. There's also some incentive for M&P buildings that were in place before that could be very advantageous. So if your clients or if you're listening to this and you're in this position and have M&P building that you're requiring before 2030, there could be some significant tax write-offs ahead of you. Other than that, there was some tidbits here and there, nothing too fundamentally significant, I would say. Pretty mild, I would say, overall, in terms of some of the policy changes. We'll see where it goes. It's not going to be automatic. There's still going to be a bit of help that the Liberals need in order to pass these rules, these budget proposals through. So we'll see if that goes through.
So one of the benefits potentially is for those people who are looking to buy planes. If the budget does pass, of course, the luxury tax may be eligible to be dropped if that's not removed in the approved budget. So for all of you for all the watchers that I have looking to buy a plane this year or in the next 5 years, that may be beneficial. Scott, I've heard that the luxury tax is still staying on automobiles. It's kind of a weird thing to drop it on one asset that's not really going to be too much volume of tax generated from that compared to autos.
Yeah, I'm not sure why they separated it out, to be honest. I'm not, there must be some rationale that I'm just not clued into, or to be honest with you, that's a part of the budget I wasn't overly focusing on, because when you're looking at the budget, we kind of have our client base in mind. And I'll be honest with you, I might have one client that has a plane, but that's an exception. It's not the norm. There was a couple announcements too with respect to the underused housing tax at the federal level, and they're dropping that for 2025 going forward. It was introduced back in 2022. Bit of an annoyance, but that one's being dropped, assuming these rules go through. And then for a third year in a row, there's these rules around bare trusts that were introduced that they've also deferred. Last year, they announced it like 5 weeks before what would be the deadline to file. The year before, it was like days before the deadline was to be filed. So at least this time around, we have a few months to absorb that. Yeah.
One of the things that you are probably going to be anticipating is tax rates in the future to pay for the deficits will have some sort of adjustment. It's inevitable that tax is going to be reframed. This is a lot of debt. This is a lot of money that's going to be spent over the next 3 to 5, $1 trillion. I almost feel like Dr. Evil saying it, inflation adjusted Dr. Evil, maybe saying $1 trillion. But anyway, obviously there's going to be some upward pressure on tax planning. And I think a lot of entrepreneurs that I have been hearing from that are considering a move out of Canada list this as the number one concern. Is the ability to not be hammered on their tax rates and the volume of tax that's incurred on their activities and their investing. Scott, what do you feel is within the scope of people that should be some of the things that they should be maybe considering when it comes to departure from Canada?
Yeah, it's a very good question. It's actually come up a lot more in the last, I would say, year or so than in prior years. And I think that has maybe to do with a lot of different things, but one of them being what you're mentioning now is the fatigue of paying such a high rate of tax. And just like when you look at salary and bonus for high income earners, that, at least for Ontario and a lot of the other provinces, it's going to be close to this rate, but it's about 53% in Ontario at the highest rate. And so on top of that, you're paying sales tax for your take-home pay and all that. So you're effectively paying an extremely high rate. So I get it. And then as your assets accumulate in value and start earning more money for you, that earning power in terms of take home pay from what it's earning is also sort of diminished because of some of the higher rates, right? So it's a hot topic. I would say in general, when people come to us, they're saying, okay, so what do I have to do? If I just leave and pick up, I'm good to go, right? I'm like, well, no, let's back up a second. Let me try to educate you a little bit in terms of what departure tax actually means. So essentially, from I guess the government's perspective, what they're trying to accomplish is that when people have certain assets, when you're looking to cease your residency in Canada, residency is what ultimately determines your taxability in Canada. So when you look to cease your residency, you're essentially meant to look at your total asset mix, right? And what Canada's view is if you have some unrealized gains within those assets that you hold, there are some exceptions, but ultimately, if there's some unrealized gains, they want to tax you on those unrealized gains at the time of departure. So for people that have non-registered investments, some real estate perhaps, um, you know, shares of private corporations, which is usually a big one for the environment that I'm in, dealing with owner-managed businesses, it could be quite significant, right? So the non-registered funds tend to be something you can work with because for more often than not, a lot of investors are turning those investments around, and maybe the accrued gains aren't quite as large as maybe some of the older folks that have traditionally just held stocks and let them sit forever, right? So I would say the non-registered funds are an easy kind of look at and saying, let's pull them up. What impact will that have on departure? Meaning they'll be deemed to dispose of on departure. So that's one item. The other one would be real estate, but Canadian real estate is exempt from departure. That'll be dealt with when you do eventually sell it. And I'll touch on that in a second. But it's actually surprisingly real estate outside of Canada that would be subject to departure tax. And that seems a little bit odd, but ultimately, as you're a resident of Canada, Canada will still view that asset as something that's accrued in value while you're resident and therefore should be subject to tax. So you essentially would have to have a deemed disposition on any foreign real estate. Lastly, the biggest one usually ends up being shares of private corporations, so owner-managed businesses. And as you can expect, that could be a very, very big number depending on how successful the business that they hold shares in. So that one's usually the toughest one to get around in terms of trying to mitigate and deal with. So at the end of the day, what we do is just take a snapshot of their assets and we say which ones are subject to departure. So those three main ones that I mentioned would be. The ones that aren't subject to departure tax would be items like Canadian real estate, even rental properties. So your principal residence, rental properties, and so on. Those will get subject to tax at the time of sale. So if you depart Canada, become a non-resident, there's a mechanism for withholding tax to apply eventually when you do sell those properties. So that's how Canada gets their piece of the pie. The withholding might be too high and you got to file to recover some, but nonetheless, that's what happens with Canadian real estate. Registered funds are also not subject to departure tax. So things like your company pension plan, RSPs, RIFs, and so on, those can continue to be held as a non-resident. The only time that you'll have to concern yourself with the tax on those is when you eventually withdraw them. So depending on what country you leave for and take up residency, will depend on the withholding rate that will apply on those withdrawals down the road. And Canada has treaties with various different countries, right? So that'll be something you deal with your advisor, or you figure it on your own for that matter. So those are the main item, the main assets that I would say are not subject to departure. And there might be other things like collectibles; those would be subject to departure tax. Not as common. Personal vehicles are usually not part of the mix. One thing I will say is when people do leave, if they have assets under 25,000, it's just there's a de minimis there. So anything that under 25,000 asset mix wise is not going to be subject to any departure tax whatsoever. So there is a little bit of out, but ultimately those are the types of assets that we would look at, and then kind of run down how much of unrealized gains are there and apply a tax rate to that. So the tax rate is going to be, if you're looking at the highest marginal rate, the tax that you're probably paying in terms of the capital gains that would be realized is just over 26% in Ontario, and equivalent across the country in and around about 1%, because your province that you're resident in will determine kind of exact rates. And then from there, it's like, how do we mitigate it? How do we get better on that? And so on. And it's not an easy thing to plan around, because ultimately you're stuck with an asset that, you can't just get rid of, because if you do, you're going to pay tax anyway, right? So it's going to be items like, let's say on private company shares, if your company's eligible for the lifetime capital gains exemption, or qualified small business shares that would be eligible for the lifetime capital gains exemption, you can claim it on departure. So there is the ability, with the uptick in the lifetime capital gains exemption limit to 1,250,000, to take advantage of that. But if the value is much more than that, then there's some issues there with potentially having to pay some tax. There could be some loss selling that you do in your portfolio to help mitigate some of the tax. And from a principal residence perspective, it's usually a little bit more advantageous to sell it before you leave. Even though it's not subject to departure tax, what'll happen with principal residences is the years that you're able to allocate as a principal residence will stop when you become a non-resident. So if you own a home, for instance, for 10 years and then decide to keep it, maybe rent it out, and you can still treat it as a principal residence for a number of years after, even if you rent it. But the point is let's say 3 years later after becoming a non-resident, so you're not going to be eligible for the small business deduction because you're no longer a CCPC. So from a corporate standpoint, there's a few other tidbits as well. In that change of status comes a deemed year end and so on. So there's a few little things that maybe not take for granted on the corporate side of things. But otherwise, for the most part, the corporation can still operate in Canada and so on. It's just another thing to add to the mix in terms of, depending on what assets you have, what's the complexity, what are things you need to think about. So that just gets added to I call it the checklist in terms of what to plan for, right?
And I think really that speaks to the importance of advice. There are things that people can DIY. If you want to tackle that bathroom renovation, I'm not even going to attempt a bathroom renovation. That's not my skill set. So I'm not going to DIY renovations, but I also respect that some people may feel that they want to DIY their tax planning. And to some people that may work, but the more complex and complicated your situation is, the more the value of advice becomes important. Scott, if somebody needs to get through to you, what's the best way to connect?
Either by phone or email. We also have a website, so www.mgca.com. My email is scloutte@mgca.com. And those are probably the two best ways to sort of get to know more about our firm. And we also have other tax partners that are part of the firm, other specialties. Departure tax is a little bit similar to how we kind of approach estate tax as well, for people that were planning for tax on death. There's a deemed disposition rule. I wouldn't compare them exactly the same, but same kind of concept in the sense that you're deemed to dispose of all your assets. So we have I deal with estates as well. We have another individual that deals quite a bit with estates as well. He's been practicing for a few years than me, and as well as a bit of a cross-border US practice. So we do have some knowledge into US being one of the more common destinations for people leaving Canada, just for either work purposes or family or whatnot. So we do have some roundness and around certain areas for planning purposes and compliance that we deal with. It's usually a one-stop shop when it comes to if we're dealing with this particular subject matter. So
Fantastic. We'll put those contact details in the show notes or the description. Make sure that if people do need to reach out to experts in this area, such as Scott, I would highly recommend at least having introductory conversations and seeing if your situation really needs a deeper look before departing Canada. Thanks for watching. If you enjoyed this content on politics, history, economics, financial literacy, and philosophy, make sure you hit that subscribe button and get notified of upcoming videos.